This is a profound question, one that sits at the intersection of philosophy, economics, and behavioral finance. How much real control do you actually have over your money? Not legally, but functionally. How much of your wealth truly belongs to you? And how much is quietly controlled by the institutions that manage, lend, and circulate it every single day? In today's economy, money above a certain threshold stops being static. It moves. Once you deposit it, your money becomes part of a financial bloodstream, fueling loans, trades, and global speculation. You still own it on paper, but the power over how it's used has shifted elsewhere. Let's define something new. Financial autonomy, the ability of an individual to control, use, and benefit from their wealth without institutional interference. There are 5 major forces that define how free or dependent your money really is. Liquidity, institutional intermediation, market risk, legal regulation, diversification, if control. Now, let's build a model to measure it. The Personal Financial Autonomy Index, or PFAI, it captures the gap between what you legally own and what you actually control. 70% in bank deposits gives an IFP around 0.4 to 0.5. Property, gold, and self-stored crypto push it up to about 0.8. Picture this graph. On the vertical axis, your autonomy. On the horizontal axis, institutional influence. As influence rises, autonomy declines. On the left, total control, but high risk. On the right, total stability, but less freedom. But somewhere in between lies a balance, where freedom meets security. This happens when institutional influence is around 0.35, and autonomy is around 0.8. It's the point where you use the system, but the system doesn't use you. Let's zoom out and see the 3 big worlds of financial control. 3 labeled points along the curve. Left, excessive isolation. Center, optimal balance. Right, institutional overreach. Here's the deeper truth. Economic power isn't just about how much money you have. It's about how freely you can use it. Wealth without autonomy is like owning a car you're not allowed to drive. The Personal Financial Autonomy Index isn't just an equation. It's a mirror of modern dependence. The real question isn't how much money you make, but how much of it you truly control. Again, the 3 big scenarios. Excessive isolation. The person keeps full independence, total control, total risk. No banks, no safety nets, no leverage. Optimal balance. The most efficient zone, part independence, part trust in the system. A harmony between autonomy and institutional reliability. Institutional overreach. The person's money looks safe, but it's not really theirs anymore. Every major decision is made by financial systems beyond their will. Economic theory teaches us that when marginal, additional cost equals marginal, additional benefit, the operator ceases to be interested in and consumes that good. In reality, this does not happen in the case of the money. Money violates the marginal utility framework because its utility is not derived from consumption, but from optionality, security, and power. Therefore, marginal utility of money is not diminishing in the classical sense, and the stopping rule of rational consumption does not apply. This is Gavril Talk Business and Philosophy. See you next time.